Fundamentals of Income Tax, Part 13, where we are going to be looking at Chapter 11 in the textbook. If you haven't downloaded one of these before, my name is Brian Clark, and I'm your instructor for this session. And this is the British Columbia version of the material that we're going to be looking at. So we will be, when we are looking at provincial subjects, we will be doing so from the British Columbia perspective. All right. With that said, let's get into it because we have a lot of material to cover. In these later chapters of the course, there is a lot of material to go over. It's quite, the textbook is quite dense. We are now getting into the deeper waters of the course for sure. So there is more material than we can cover in granular detail in 3 hours or even in a session and a half. So please make sure to read the textbook, and if you have any additional questions after listening to this and reading the textbook, just reach out to your and email your instructor if there's anything you would like clarifying. But on that note, welcome back, everyone. Here it is a couple days before Halloween, so I hope everyone has been preparing and stocking up on candy, if necessary, putting out magical protections around your house so that no ghosts and goblins get into it. Been a pretty nice day here in Vancouver today, so that's pretty good. I hope students that you all had a decent day off. And as always, just a reminder, if you have any troubles with sound during the presentation, if it's on your end, you can follow the steps on this checklist here. If you get kicked out of the classroom and have to come back in due to an internet connection drop or something like that, remember the last stage in this checklist here is to make sure that you've clicked the dialog option that says yes when WebEx prompts you to, if you want to join the conference. Sometimes WebEx, if you click it twice, it will open 2 WebEx sessions, one on top of the other, and it's not always obvious that that's what's happened. So until you start closing some windows, you won't see that option. And WebEx will sometimes spawn that window underneath another window entirely. So just be on the lookout for that if you can't quite figure out what's going on. WebEx, of course, a little bit of a temperamental platform sometimes, and sometimes it will mute the presenter without giving an obvious visual cue that it's done so. So if my audio suddenly drops out and it doesn't appear to be deliberate, just get my attention in the chat, students, or else Doreen will say a word to let me know that that's happened. All right. Yesterday that happened while I was giving the students some quiet time to work on a problem, and so as a result, none of us are exactly sure when it dropped out, but hopefully we won't have that issue tonight. All right, so just a reminder to everyone, questions are very good. Questions are very important to the functioning of the course. It helps me understand if there's anything which is causing confusion. So feedback while I am teaching is good and it is valuable. As always, if you are having trouble with something, probably you are not the only one. And certainly the people who've downloaded this online, they don't have the chance to ask questions. So by asking questions, you are enriching the course for everybody. So please don't be shy. There's no such thing as a bad question. There is sometimes a question which we will get to later in the course, and I will politely defer until then. All right, so in our last class, we tackled the very large subject of taxpayers and health and various things related to health. This is such a big subject, of course, that we spread it over 2 class sessions. In the previous class, we talked about the more unusual aspects of health and medical expenses related topics. So we looked at the home accessibility tax credit, which is an interesting second tax credit which can be used to claim home renovations for accessibility purposes. It's unusual in that you can claim those expenses as a medical expense and as a home accessibility expense if someone is disabled. And it is also available to seniors who will usually claim it on their only as a home accessibility credit if they are not disabled. We also looked at the disability sports deduction, which is a deduction whereby you can claim medical type expenses such as attendant care or assistance devices as essentially a deduction from your earned income, your employment income. So that is interesting. And that's aimed at medical expenses incurred to allow disabled people to work or go to school. We looked at the refundable medical expense supplement, which is an interesting credit because although its parameters are a little bit narrow, it is aimed at working people with earned income under a certain threshold who have relatively high medical expenses. So it allows people who would not normally benefit from the medical expenses non-refundable tax credit to get back a refundable tax credit in addition. And then we looked at the interrelationship between the disability tax credit, nursing home fees, and attendant care fees, and how claiming these things can sometimes interfere with claiming the disability tax credit itself. There's a detailed chart in the textbook with a lot of frequently asked questions, but the chart itself is fairly easy to read and quick to refer to in case there's a question about this on the exam. Hint, hint. All right, so apart from that, any questions from last time? Now, we are going to have a brief look at the two things we didn't quite cover from chapter review problem 10-1, but so I'll get to that next. But any other questions, guys, before we look at the schedules from 10-1? Okay, if not, we'll have a look at 10-1, particularly for the folks downloading this online who may have questions that we weren't able to get to last time. As I say, it was a fairly full session. So in chapter review 10-1, we asked you all to do some questions, which we reviewed in our last session, went through all the answers for those, and also to produce this, look at the Schedule 2 and the Schedule 5, with a couple. I'm also going to have another look at chapter review problem 10-1 when we get to chapter 14, and we will have a look at the British Columbia provincial credit for home accessibility expenses. But I'm going to save that until chapter 14 when we talk about advanced provincial topics. All right, so first of all, Schedule 2. Now, for those of you who might not have the last problem handy, we can pull that up just for context. So just quick context here, because out of context, it might look a little odd to look at Schedule 2. So this, of course, was for Adam and Gail East. Dr. East, Adam East, was working. He was the primary supporting person. He had a variety of income, as did his wife, Gail. Gail's has relatively low income, and as she is permanently disabled. So this is a case where we're going to be looking at Schedule 2 for transfers between spouses and Schedule 5 where the spousal amount is calculated as well. And then we will have a look at the federal worksheet, and I had a request to have a look at the BC 428. So we'll have a look at all those things. But first, so the Schedule 5 here for Adam and Gail. This is an example of claiming the spousal credit, spouse or common law partner amount, that is, in a case where someone is infirm. So in this case, Gail is infirm, and so we're going to be claiming the Canada caregiver amount. So as you can see, on line 1, we have Adam's basic personal amount. Note, not Gail's, Adam. So it's based on Adam's income. So if Adam had really high income, he would claim a lower personal amount here. But he's in the bottom 3 tax brackets, so it's fine. He gets the full $15,705. And then this is increased by the Canada caregiver amount for Gail, $2,616. So that is added in here. Line 1 plus line 2 is $18,321. Now, some of my students in the other class had trouble with this. It's important to remember that we have to deduct Gail's income. So Gail's income here, $5,343 is deducted, and that leaves us our final result of $12,978. And that is what is going to be claimed on line 30300 of the return. So that's the Schedule 5. And remember, Schedule 5 is used to calculate personal amounts. Schedule 2 is used for transfers between within a couple, between spouses or common law partners. And I found it my first few years doing tax, it was easy to confuse Schedule 2 and Schedule 5, but the easy way to remember it is Schedule 2 is for two people, it is for a couple only. So in this case, you can see what happens. We total up all of the various credits which could be transferred. So again, that's the age amount, the pension income amount, the disability amount, the tuition amount, and the Canada caregiver amount for infirm children under 18. The only one that applies here is the disability amount. Today we're going to be learning about the age amount and the pension income amount. Don't worry, we'll be getting to the tuition amount soon enough after that. So the disability amount for Gail is entered here. So this is the only credit which can be transferred. And in this section, we look at Gail's income to see how much of this credit she needs to claim herself. Now, her income, $53.43, is less than her basic personal credit of $15,705. This means she did not need to use any of this credit, so therefore the entire amount, $98.72, is going to appear on line 32600 of the return. All right, and I see a question. Well, that's a very good question, Diane. So what Diane has noticed here, and what Diane has noticed here, and I'll just annotate it for you, just in the interest of speed, is this section here. What is this about? Now, we only do this, you might notice, if the spouse or common law partner's income is more than $55,867. Then we need to divide it by 15% to create the effective income. Now, why can anyone tell me why they think that might be? So in this case, it doesn't apply because Gail's income is less than $55,867. Why do you think it might be that we have to divide it by 15% if it is higher than $55,867? Can anyone guess? Right, it's to do with the tax bracket. So remember that tax credits only cancel out tax at a rate of 15%. So if someone has income in the second tax bracket or higher, then that income effectively needs more tax credits in order to cancel it out. So to create that effect, then we take that higher amount of income and we take the amount from line 81 of the return and divide it by 15%, right? So that only applies if someone's, in other words, how many 15% tax credit dollars are needed to cancel out income at the higher tax rates. In other words, tax credits in the bottom tax bracket cancel out tax on a $1 of tax credit cancels out $1 of income basis. Above that rate, you need slightly more than $1 of tax credit to cancel out $1 of income. So this is what that is meant to simulate. Okay, but in this case, Gail's income is quite low, so we don't need to worry about that here. But that's what that is. Right. Yes, if I'm not sure we'll have time to do it today, remind me. If we have some time at the end of the class, I can show you an example. If not, I'll create an example for next time and show you when this might come into play. This particularly comes into play with students who sometimes have very large amounts of tuition carry forward, but can also have income over the first bracket. So if we don't get to it today, I will try to give you an example when we talk about students in Chapter 13. Let me make a note to myself that I'm going to follow that up, though, so just bear with me for a second. Okay. Yes, because 3 hours from now, I may not. I may have trouble remembering that. All right, good. But that's a good observation. But that is the purpose of that. Fine. Okay. Now, the other thing we're going to look at here is the federal worksheet for the home accessibility expenses. So, and it is relatively straightforward. So, for home accessibility expenses, the entries are quite similar whether you're claiming them for the home accessibility expenses credit, for the multi-generational home refundable tax credit, or for the British Columbia home accessibility tax credit. The basic format is always the same. You enter the date of the sales slip of the contract, the name of the supplier or contractor. If there's a GST number, you enter that. You enter a description of the goods or the service, and then the amount paid. So here it was $2,900. This is not being split between Adam and Gail, so we don't deduct anything for Gail's return, and the entire amount is then going to be claimed by Adam as a home accessibility expense on line 31285 of the return. Just like that. Okay, so, and we wanted to have a look at the return itself. So there was a request to look at the federal worksheet, but we just looked at that. So, but there was also a request to look at the BC 428. So let's have a look at that, and the BC schedule too. So the BC 428, you can see here that Adam's income is entered up here, and it is taxed in the second British Columbia tax bracket, 4943.27 of British Columbia tax. And then for Adam's tax credits, provincial tax credits, so he's got the basic personal amount of $12,580. For Gail, so notice the spouse or common law partner amount in British Columbia is a maximum of $10,772. However, she's allowed a little bit of income, so her income is deducted from a slightly higher amount, $11,850, and so this leaves $6,507, which is claimed as the spouse or common law partner amount. So there's no equivalent, no provincial equivalent of Schedule 5 is the key thing to note here. Amount for eligible dependents similarly is calculated directly on the 428. There is no BC Schedule 5. So for the personal credits, it's $19,087. And then you scroll down here for other credits. So CPP contributions, EI contributions are just taken from the federal return. Of course, there is no such thing as, there's no provincial equivalent of the Canada employment amount. So the total tax credits then are $23,353.62. The amounts transferred from the spouse or common law partner, $9,435, and that is calculated on the BC Schedule 2. Now, so $9,435. If we compare that to the amount on the federal Schedule 2, that is slightly different. So federally, it's $9,872. Provincially, it's $9,435. So obviously, the BC Schedule 2 does things a little bit differently. So we'll have a look at that in a moment. Medical expenses, however, notice that is done similarly. We take the amount from line 33099 of the return. It's reduced by 3% of the net income, or a maximum of $26.16. So again, notice that's slightly different from the federal amount. So 3% of the net income is deducted from the 6215 to give 3795.98. So notice there's no non-refundable tax credit, which is the equivalent of the home accessibility expenses. In British Columbia, that is a refundable tax credit, and we'll look at that in our Chapter 14 discussion when we've got a little more time. And the BC charitable donations come in down here. So we take our BC British Columbia tax, 4943.27, deduct the non-refundable tax credits to get 3,038.80. There is no tax reduction because the income is above 39,703. So that will be the final British Columbia tax, 3,038.80. When we look at the BC Schedule 2, all right, so the disability amount is brought in from Gales BC 428, 9,435, right? So the disability amount in British Columbia then we can deduce is different from the federal one. And indeed, if we were to look at just up here, Adams BC 428 for an example, you can see that the provincial disability amount for self is 9,435, slightly different from federal. Similar enough that it might be a little misleading, and you might think they're the same, but they are slightly different. So every province can have small variations like this, and it's important to keep an eye on it. All right, in Chapter 14 then, when we get there in a couple sessions, we will look at the BC refundable tax credit for home accessibility expenses. But for now, any other questions about 10-1, guys, before we move on? And as always, if you have any questions that you think of later, feel free to send them my way, and I will respond to them as soon as I can. I am currently working through a stack of emails, so if I haven't got to yours yet, don't worry, I have received it. In some cases, I'm thinking about what to do, but I have to give priority to things like sending out the slides and preparing for my next class and things like that. So I have to kind of respond to the emails when it's slightly less busy. All right. Oh, the final refund or balance owing. You know what, Diane? Let's hold on to that till Chapter 14, and then we'll do that all at once. Because I do want to show you the BC refundable tax credit, and I want to make sure that that's in there correctly. Now, and Karina asks, what is the difference between refundable and non-refundable credits? So anyone want? Can anyone answer for Karina? Or I think most of you know the difference, but how can we express it? Is there an easy way to explain it? Good, that's right. So a non-refundable tax credit can only reduce the tax owing. It cannot reduce the tax owing below zero, so it cannot create a refund, hence non-refundable. A refundable credit reduces your balance payable and can reduce it from below zero, and thus you can get a refund from it. So with a refundable tax credit, even if your income is zero, if you have a refundable tax credit, you will get some money back, right? And in general, the non-refundable tax credits are found in Step 5 of the tax return, Parts B and C. Refundable tax credits are in Step 6 of the tax return, or they are completely separate from the tax return, like the GST payments which are sent out, and the Canada Child Benefit, and as we learned about last time, the new Canada Disability Benefit, right? So that's kind of the difference, and we often have to explain this to clients who for whom it might not be clear. And they say, oh, well, I've got all these non-refundable tax credits. How come I'm not getting any money back? And then you have to explain how that works. All right. So tonight, then, we are going to be looking at the donations, Stacy. Okay, we can have a look at that. Now, the donations, for the donations, I think it's helpful to look at the problem, I think. So for the donations, what you always have to watch for is, are there any donations on the T4? So here, there's 400 in separate donations, one for the Salvation Army, one for the Heart and Stroke Foundation. One's donated by Gail, one's donated by Adam, but of course spouses, common law partners can combine donations. They don't have to. It is entirely optional. People will get annoyed if you just go ahead and combine them without making clear that it's optional and you're not just doing things for funsies. So in this case, there's $400 in donations from the two of them, plus $57 from Adam's T4. So $457. And so that $457 will show up on Schedule 9 right up here, which it's a little tricky to jump around in the PDF, but yes, Schedule 9. So the $457 is entered here as a donation. It's much less than the maximum donations limit, and the donations credit is then calculated down here. So the first $200 is credited 15%, so that's $30. The next $257, 29%, or $74.53. For the medical expenses, the total medical expenses let's get there. All right, so the total medical expenses are $6,215. Okay. And that will give us a medical expense credit on line 33200 of $37.95.90. Okay, so looking back at the problem, so that number is arrived at because the optimal period for 12 months goes from September 9th, 2023 to September 8th, 2024. Remember, it's a maximum of 12 months. Oh, really? Gonna do that, are you? All right, there we go. Okay. I was in the middle of something. Online services, but I don't want to save that. So, as I was saying, September 9th, 2023, right there, and until September 8th, 2024. Now, so in addition, the things we're going to claim are the $785 in dental x-rays, the $370 in prescription drugs, and the $320 in prescription eyeglasses. We cannot claim the non-prescription vitamins. We are also going to claim the stair lift installation cost of $2,900. So remember, we can claim that as a home accessibility expense and as a medical expense. Home accessibility expenses are a special exception to the rule that things you can only claim a given dollar one time, right? And also 8 months of Blue Cross premiums. So specifies in the problem that, what is it here? They pay $230 per month to the Blue Cross for private healthcare insurance, and this is paid monthly, and all the payments for 2023 were claimed on the 2023 tax return. All right, so now there is some discussion online about whether the East should go back and adjust the previous year's tax return. For simplicity's sake, our solution is assuming that the 2023 Blue Cross payments were claimed on the 2023 return. Okay, so that's how we arrive at the total figure, which is, again, just in case anyone needs it one more time, especially those of you who downloaded this online. So total medical expenses of $62.15, and this will give you a medical expenses credit of $37.95.98. All right. All right. There we go. Now, tonight we are going to be moving on to Chapter 11. Now, Chapter 11 is about senior taxpayers, and the interesting, they have several, what's a good word for it? Challenges. No, there are several things which you are typically only encountered on seniors' tax returns. They have several tax credits which are dedicated to seniors, and seniors in general tend to have more medical expenses and charitable donations compared to someone who is just starting out in life. So there's a lot of things to look at here. As well, seniors typically are collecting old age security income and CPP benefits, as well as pension income. So we're going to talk about all those things and how those are handled on the tax return. For seniors, they reach a point in life where their RSP plans are now converted into income plans. So we're going to be talking about how that happens and what happens when you get a retirement payout or buyout from a company and then you want to transfer it into an RSP. And we're going to look at some non-refundable tax credits which are specific to seniors, some of which I've already mentioned tonight, and we'll see again, that show up on the schedule too. We're going to talk about a special feature that seniors, mainly seniors, I should say, can take advantage of, called pension income splitting. And then we're going to look at installment payments, which is something that seniors often run into. Okay, but and remember, these learning objectives here are in the textbook at the beginning of every chapter. So at the conclusion of this chapter, then, you should be able to explain how old age security benefits and guaranteed income supplements are reported on a tax return, the nature of CPP or QPP retirement benefits and post-retirement benefits, how to include those on a tax return. You're going to have a sense of how to treat the various different pension and annuity income types on a tax return, which is a pretty broad subject, in fact. And you're going to be able to describe the income types that can come from a registered retirement income fund and properly enter those on a tax return, as well as income from a registered retirement savings plan, and retiring allowances, how we report those on a tax return, and how, under some circumstances, we can transfer some of those directly into a registered pension plan, RRSP or otherwise. You're also going to be able to determine eligibility for pension income splitting, and you'll know how to complete Form T1032, which is the joint election to split pension income. You'll also be able to claim the various non-refundable credits to which a senior taxpayer is entitled, and determine when installment payments are required, and calculate the amounts to be remitted each quarter. So quite a lot of material again tonight. We will get as far as we can, and hopefully we'll have some time for the chapter review problem at the end of it. If not, we will carry that over into our next session. All right, because first, we are going to go through self-test number 4. Now, I've been talking a while, so you've all had a time to finish it, I think. For those of you at home, if you haven't done this yet, please pause the recording to do the answers, and then we'll go through them together. All right, let me bring up my poll over here and pull up the question. Self-test for Q1. There we go. Right, so, and bring that down here so I'm not obscuring things too much. So question number 1. Wayne and Stephanie separated in September. Wayne moved out but continued to pay the rent on the apartment that Stephanie and their daughter continued to reside in. Wayne also buys clothing for their daughter, and he would also give Stephanie money occasionally. Aw, good guy, Wayne. They never wrote down any sort of agreement with respect to their separation, and they have not gone to court. Stephanie would like to claim the eligible dependent amount for her daughter. Can Stephanie make the claim? Yes or no? All right. Let's open the poll. Let's set it for 1 minute, and let's see what you think. Yes or no? Remember, these self-test questions are not for marks. They're just to give you a chance to assess how well you absorb the material. Lets me know if there's some confusion out there amongst the class. So, don't be afraid to take a guess. After all, this was your final exam. If you don't guess, you have no chance of getting marks. So, don't be shy. Take a stab at it. Of course, I always assume that at any given moment, 1 or 2 students are away from the keyboard getting a drink of water, and so that's fine. But otherwise, take a stab at it. All right, good. And why are you doing that? All right, WebEx is just tallying the responses for about 10 seconds here. And once it's done that, I can wake up PowerPoint. Software. Right, there we go. So, there we go. All right, back, please. All right, so the answer is no. Stephanie continued to be supported by Wayne, and most of you, the most popular answer was no, so most of you did get that correct. So remember here, if you're having trouble, and remember, with anything related to an eligible dependent claim, you can look at the checklist, which we have in the facts and figures. Support under terms of a written agreement does not disqualify someone from claiming the amount for eligible dependent, but non-mandated support, that is voluntary support during the year, effectively means that the person, while their marital status may not be married or common law, financially they are still in some sense a couple, and thus the amount for eligible dependent cannot be claimed in this case. Right. Even if Stephanie might not feel the case, legally speaking, she's still being supported in some sense. All right, let's look at question number 2. I'll just pull that up here. There we go, there we go. All right, so Melina and Hein have been dating for years. They moved in together March 11th, 2024. Melina gave birth to their first child on July 23rd, 2024, and they are still living together. So, what's going on? I swear. All right, hang on. All right, so, question is, on which date did they become a common law partner? Is it A, March 11th, 2024, July 23rd, 2024, March 11th, 2025, or July 23rd, 2025? Let's give you a minute and see what you think. And there we go. All right, let's see. Got about 25 seconds left. More of a spread of answers this time, although I do notice that most people have got the correct answer here. All right, but some people have yet to answer, so let's see how everyone does. All right. Very good. And indeed, most of you, the most popular answer is the correct one. Most of you got the correct answer. Yes, the correct answer is July 23rd, 2024. So remember, when a child is involved, either biological or by adoption, or under the expanded definition of child that exists for tax purposes, that is, someone is acting as a parent, they have custody and control. In that case, the common law status begins immediately with the arrival of the child. So in this case, March 23rd, July 23rd, July 23rd, 2024. There is no 12-month waiting period in this case. Mohammed, I'm not sure I understand. Not a birth of a child. The child could be adopted. Okay. So someone could have a child, and then someone moves in with them and starts acting as a parent, right? So once the child is there, and the other person is acting as a parent or is the biological parent, then they are immediately common law. Yeah. So I think, Mohammed, what you're wondering, is it necessary to have a legal agreement or anything like that? In this case, it is not. All that is required is the presence of a child or that 12 months have elapsed. I have done taxes for people where they are very surprised to learn that they are, in fact, common law. And then I have to explain to them how certain things work under the law, and that conversation can be very interesting sometimes. But yeah, so there's no need for any kind of legal agreement, and often, sometimes people are unaware that it has in fact happened. The basic reason for this is that it allows for greater protection for the child's interests fundamentally, and greater support to be offered. All right, but it gets into various policy discussions pretty quickly. All right. Yes, or the 12 months of living together is required. That's right. So it's either 12 months of living together at the same address, or if there is a child, it is immediate when the child arrives. If there is no child, it is a full 12 months. Okay, let's look at question number 3. And let me pull up that poll question down here. And okay, and set that timer for 1 minute. Okay. Okay, so this is a yes/no question. Jared would like to claim the cost of his hair plugs because he considers it a medical procedure. Jared has not been in any accidents or suffered from disfiguring illness. Can he claim this as a medical expense? Okay, now, any of you who weren't here last time or didn't read the chapter too closely, you've got a reasonable chance of getting this if you think carefully about this. But remember, for anything where you're unsure if it's a medical expense, you can look that up on the CRA website. If in an exam situation, say, remember our exams are open book. But for you guys, you only have a minute to decide yes or no. Is this a medical expense? Okay, very good. 100% of you who answered got the correct answer. Very good, very good. Yes, the answer here is no, because it is for purely cosmetic reasons, right? This was actually changed some years ago. I forget the exact year. It's been at least 10 years. The CRA brought in a clarification to say that cosmetic procedures that are done purely for cosmetic reasons cannot be claimed as a medical expense. Now, it is sometimes possible to claim them under some other provision. Some other provision. I think you can imagine, for example, if someone was an actor or an actress or maybe a professional wrestler, and they needed to get some work done for business reasons, then maybe it's a business expense. But as a medical expense, no, not unless there's a medical reason for it or a prescription. So cancer patients can get prescription wigs and so forth. So a disfiguring illness, an accident, say, that's different. But, if someone's just getting their hair, getting new hair for fun, then no, you can't claim that. All right. Question number 4. All right, let me pull up the poll question here. There we are, self-test 4, question 4. Oh, 5 options for this one. All right. Let me just get that set there. Okay. All right. So Sarah uses a wheelchair and has Form T2201 certified by the CRA. Sarah would like to claim the costs of installing a mobility lift in her house as an expense on her tax return. How could she claim this as an expense on her tax return? A, only as a medical expense. B, only as a home accessibility expense. C, either as a medical expense or a home accessibility expense. D, both as a medical expense and a home accessibility expense. Or E, it cannot be claimed on the tax return. Now, we spent a fair amount of time on this last time, so I'm expecting good results. Please tell me what you think. All right, good stuff. And most of you got the correct answer. Correct answer is D, both as a medical expense and a home accessibility expense, right? So remember, this is a special exception to the rule that you can't claim the same dollar twice on a tax return. For disabled individuals or mobility impaired individuals who can claim home accessibility renovations as a medical expense, they can also claim them as a home accessibility expense. And there is a matching BC provincial credit as well, which we'll talk about in Chapter 14. Notice, however, if Sarah had been a senior and wasn't disabled or didn't have a T2201, then she would only be able to claim it as a home accessibility expense. Now, Bilab, you're asking, is the theory exam going to be questions similar to these? Yes, I believe. I haven't looked at it in a few weeks. I edited it. I proofread it. So, but it has been several weeks. The theory exam is multiple choice and short answer. So it's going to be similar to these sorts of questions. It's different from the theory exam we used to give, and I may have told you guys about this, but back when we taught in-person classes, the final theory exam was you had to do the tax returns for a family. So it was 3 full tax returns in a fairly detailed situation for a couple and a daughter who was a student, and it was it took a full 3 hours, and it took a lot of time to mark, frankly. So the modern exam is in that respect better. But yes, our questions are going to be similar to these. You're going to be given a relatively straightforward question to which there's a pretty clear answer. And because it's an open book exam, you will have time to check in the textbook to look things up. You won't have so much time that you can spend a lot of time looking every single question up. So it is important that you study and have an idea of the answers, but you don't need to panic about memorizing every single line number or things like that. All right, question number 5. Let's pull up that poll. It should be right over here. There we go. Again, a nice yes/no question. We'll set our timer for 1 minute. And there we are. And here's the question. So Eric has Form T2201 on file with the CRA, and he has a receipt from a retirement home that indicates $9,500 of his fees were spent on attendant care. So, is Eric able to claim both the disability amount and the full amount of the attendant care fees as a medical expense on his return? Yes or no? All right, you've got a minute. Take a stab at it. All right, everyone's finished, and WebEx is just tabulating the results for people who still have the window open. All right, so a much more even split this time. Okay, so the basic answer here, so the first thing to look at is how much were the fees for? They are less than $10,000. That is a break point, remember. So you can claim attendant care fees less than $10,000 and claim the disability amount. That is always okay, providing the fees are identified as attendant care fees. So if the nursing home, the retirement home in this case, did not specify how much of their fees were for attendant care, in other words, if the receipt from the retirement home just said that Eric spent $9,500 on retirement home fees, then he wouldn't be able to claim it. You can only claim attendant care, which is done in a nursing home or retirement home. Any other fee from those facilities cannot be claimed, right? That's the key thing. And again, it needs to be $10,000 or less. If you're claiming attendant care over $10,000, you cannot claim the disability amount in addition. So you need to look at it and carefully weigh which would be more advantageous in a given situation. All right. Any other questions on that, guys? And do remember, with attendant care and the interaction between that and nursing home fees, there is that diagram and that chart in the textbook. If you haven't had a look at that, please do have a look at it. It's the sort of thing that's very helpful to be able to look up quickly in an exam situation. But that section also has a lot of frequently asked questions and goes into more detail than we were able to get into in class. So I do encourage all of you to have a look at that if you haven't already. All right, so on that note, let's move on to our new material for tonight. So the first thing we're going to talk about is a common sort of income for seniors, and that is old age security benefits. Now, old age security benefits, we haven't really talked about them very much in the course up to this point, but we've kind of mentioned them in passing in the background. These are paid to eligible Canadian residents aged 65 years or older. And to qualify for these benefits, it's necessary to have resided in Canada for a minimum of 10 years. Now, the length of time you've spent in Canada factors into this. So the maximum amount is paid if you have resided in Canada for 10 or more years, for 40 years or more. Now, this is one of the reasons, by the way, that it is important to file taxes, even when you have no income, because when you file taxes, you are, in effect, attesting that you were a resident of Canada during a given year, which might seem strange, but the Government of Canada, if you don't file tax, doesn't actually, Service Canada can't actually just look up and tell how many years you were in Canada as a resident. This is also one of the few reasons why you might go back more than 10 years to file a missing return, is to file and attest that someone was resident in Canada during a given year and perhaps didn't have income and didn't file for that reason. But this is one of the few reasons where situations where you would go back more than 10 years to file a return. We will talk more about that in Chapter 15 when we talk about filing past returns and adjustments and things like that. But yeah, just do bear in mind, even though we often talk about going back and doing past returns, there being a limit of 10 years, it is possible to go back more than 10 years to file taxes. It's just that there is rarely a reason that would require it. This is one of them. Income from old age security is reported on a T4A OAS, and the amount that you receive is based on your age when you begin to require. So collect it, so age 65 to 74 or 75 plus, and it is also based on your income. If your income is high enough, you may have to repay some of the old age security, as you will see. Now, the amount you receive from old age security is adjusted every quarter for inflation. So when you have to go back and figure out how much old age security someone received in a given month, it's not always as simple as just taking the amount from the T4A OAS and dividing it by 12. So sometimes you have to go back and see, okay, what were the payments in this month? What did they change to in this month? And so on per each quarter. All right, repayment we will talk about shortly. We will get there. But first, it's important to be aware that get back here, I said. All right, so you do have the option to defer receiving old age security benefits for up to 5 years. So this may be of interest to taxpayers when they are still working, so their income is relatively high, and thus they might have to repay some of the OAS because of the high income. So they might want to defer receiving it for 5 years. And by deferring it, for each month they defer it, they will receive an additional 0.6% per month when they start to collect. So if you hold off until age 70, you will get an additional 36% per month, which is pretty significant. So if you're still working up until age 70 and want to hold off collecting the pension, there is a benefit to you. Now, question here. Okay, Muhammad asks, so if someone lives in Canada for 10 years and after 10 years he goes to another country, then he should be able to collect OAS after age 65. Yes. When we're talking about other countries, though, it can get a bit complex because it depends on the particular agreement Canada has with that particular country. This is beyond the scope of this course, but just so you're aware, there's the general term for this is called a Social Security Compact. And Canada has agreements with various countries. The basic rule under which is time spent in one country can be applied towards the requirements for collecting a pension in the other country, but the details depend on the two countries involved. But if you've been a resident of Canada for 10 years, you may be eligible to collect an old age security pension from Canada, even if you are retired to another country. So some of my clients are living outside Canada and collecting old age security pensions. And some of my clients are living in Canada and collecting an equivalent of old age security from another country. So this is not at all uncommon. The max amount is paid after 40 years. Well, basically, the longer you are a resident of Canada, the higher your monthly payments are going to be, up to a maximum. Does that help, Mohammed? So basically, if you've only been in Canada for 10 years, you're going to receive a smaller amount than if you've been in Canada for 40 years. And if you were in Canada longer than 40 years, it's not going to go any higher. You're already receiving the maximum per month. Okay, so, all right. Okay. So when you receive the T4A OAS, and we will, similar to a CTP, it had, we'll look at the form in a moment, but it's superficially similar to a T4AP. So box 18 has the net amount of old age security that's paid. Box 19 has the gross amount of old age security paid. So that is not reported on the tax return. Often these numbers will be the same. The reason they might be different is that there's such a thing as an overpayment. So similar to EI, this is when somebody receives old age security during the year in a higher amount than they should have. So in that case, an overpayment on box 20 will be claimed on line 23200. So the net amount of OAS is reported on line 11300, and that is the income that is reported. Box 19, the gross amount is not reported on the tax return. Now, there is what's called a supplement. And we're going to talk about that in the next slide. So this is additional money, which is not reported on line 11300 and instead reported on 14600. And this is then deducted on line 25000. Okay, so box 18 plus box 21 is what someone receives in the year. And box 22 is when income tax has been withheld. And that is only withheld if the person requests that income tax be withheld. You really want to watch out for that because often people assume that it is blank without looking closely at it, and you really do want to look at it closely to see if any income tax has been withheld. All right. And Bila was asking about the supplement. Well, old age security. No, I think the thrust of your question, Bila. Old age security, despite the fact that it is on a T4 OAS, this is not like CPP income. You receive this money simply for having been a resident of Canada. It is not based on your working income. It is simply once you get to a certain age, the government will give you some money to help sustain you because you probably can't work as much anymore. The general term for this type of social support income is called Social Security, and many, if not most countries, have some sort of support payment like this for senior citizens. Sorry, that should read T4A OAS. Huh. Yeah, no, that's the T4A OAS. Sorry. Yeah, so let me fix that. Okay. Yeah, T4A OAS. There we go. Good catch. Good catch. All right. Yeah, so T4A OAS. T4s are only a T4 and nothing else is only for employment income. T4A is generally for other types of income, which are often related to employment income. But in this case, in this particular case, it's not directly related to employment income. It's simply related to having been resident of Canada. Now, do you receive it if you have? Can you receive it if you have other income? Yes, you can, but hold on to that thought. Most people, when they retire in Canada, will receive old age security income and income from the Canada Pension Plan. The government sends out these two forms together. As you'll see, they even sometimes print them together. So most people will qualify for both this and the Canada Pension Plan, although not always. Some people have not worked in Canada, and some people have not resided in Canada for 10 years, but most people will receive both. Now, part of that money in box 21 that we just mentioned, box 21, is what's called the Guaranteed Income Supplement. So this is for low-income seniors. So low-income pensioners over a certain age and whose income is below a certain level will receive this kind of top-up amount called a Guaranteed Income Supplement. Now, the Guaranteed Income Supplement is a form of social assistance. And so it is not taxable and is deducted. It is included in income and then deducted from net income to give a lower taxable income. Now, spouses or common law partners who are age 60 to 64 of pensioners receiving old OAS and the GIS may also receive an allowance, depending on the situation, generally if their income is also low. The GIS and the allowance are both non-taxable, and recipients do not need to reapply for benefits if they file their taxes before the deadline. Let me see, before I move on, just want to make sure I'm not missing anything. So again, to stress, the regular old age security payment is taxable, right? So that amount in box 18 is taxable. The amount in box 21, the supplement, is not. So the GIS is what the senior themselves receives. The allowance is what goes to the spouse. So that's why we refer to them as two separate things, GIS and allowance. All right. So seniors who do not file tax returns in a timely fashion will lose their GIS payments and any similar provincial payments. And so it's another important reason for them to file tax returns on time. So that is something to watch out for. So the supplements are identified in box 21 of the T4A OAS. As you can see, it's fairly simple, straightforward form. Tax years up here. Box 18 is the taxable pension paid. The gross pension here is not reported on the return. And then if there's been any overpayment in the year that was covered in the year, that comes in here. And then either the federal income tax or Quebec income tax that was deducted is entered up here. And then the social insurance number and their old age security number is entered in there. Right, it's a fairly straightforward return. Usually, it is sent out to, as I say, it's usually sent out to people together with the T4AP for people's Canada Pension Retirement Benefits. Usually, this is printed on yellow paper, and the CPP is printed on orange or kind of a peach-colored paper to visually distinguish them. But sometimes they are just sent out on plain white paper. Either way, they are very, very often sent out together because usually someone receiving one is receiving the other one, and they're both sent out by Service Canada at the same time. All right, now let's see how well you remember. So we've already talked about social assistance income and workers' compensation income as being reportable and not taxable. So who can tell me, who remembers specifically how this is handled on the tax return? So what lines are involved? And if you've got the tax return open in front of you, you can just have a look at it. Otherwise, see if you can remember what lines are involved. Nope, not 11300. 11300. That is for old age. We're talking about social assistance income. So remember, this is income that you would receive on a T5007. So good, Diane, Muhammad, good. 14500 is for social assistance. 14400 is for WCD payments. And then they are deducted on line 25000. Okay? So that's the key thing to remember. So social assistance payments of this type are social benefits of this type. They're reported on line 14400 for social assistance, 14500 for workers' compensation income, and 14600 for the guaranteed income supplement and the matching allowance. And all of them are deducted on line 25000. Good. So again, the GIS and the allowance is just treated the same as social assistance income and workers' compensation income, which we've already discussed. Now, similar to EI, the old age security payments are intended as an income supplement for seniors of modest means, whose income is relatively low. So seniors, therefore, must pay back all or a portion of their old age security income if their income exceeds a certain amount. Now, this makes philosophical sense if we remember that this is an income supplement for lower income seniors, and it is not based on your income. That is, you, a resident of Canada, have not paid money into the old age security plan specifically, which is different from the Canada Pension Plan, where you have put money into it. This is just the government of Canada sending you money to support you in your old age. And if your income is above a certain level, then the old age security will be reduced. So the repayment will be the lesser of the total old age security benefits received and 15% of the net income in excess of $90,997 reported on line 23400. So this is calculated during the federal worksheet. So we're going to show you the federal worksheet in a moment. Couple things to note here. So this repayment then will often lead to the government withholding tax on subsequent old age security payments in future years, as we will see. And this will show up as income tax deducted on the T4A OAS. Now, some seniors have complained to me over the years about this because they don't feel that they should be having to repay this, and they have income in over 6 figures. They may have income in 150,000, and they may feel that they are seniors of modest income and low income, but the line has to be drawn somewhere, and currently it's at net income of $90,997, and this is, of course, indexed for inflation. So we'll look at that repayment in a moment, but I see a question here. Yes, so let's have a look at the social benefits repayment here. I think this will illustrate what you're asking about. So you're saying that the statement in the textbook is when you're performing this calculation, which we see here, right? The line 23400 amount net of RDSP must first be reduced by any EI benefit repayment. Okay, so let's walk through this form, and I think this will clarify it. So the 23400 amount, and again, for anyone who doesn't have it, let's pull up a T1, so we've got that handy. You guys can hear me okay? Thought I heard a sound there. Let me just pull up a T1 for a second. T1 will be in our fillable forms over here, and it will be BC. T10R, there we go. And so just so we've got in front of us, the line 234. So the 234 amount here that we're referring to is, of course, the net income before adjustments. And what are the adjustments? Well, they are the social benefits repayment here on line 23500. So what that means then is you're taking the net income from this amount, and then you run this calculation on the federal worksheet. And the federal worksheet, we'll walk through it step by step, and then I think it will be clear. So just hang in. Okay. There we go. Okay, so Diane. So the way it works is this. So we enter the, now notice, the chart here is going to be used. If you have EI income and your net income is higher than 79,000, and or if you have old age security income and your net income is higher than 90,997. So those are the two situations where you need to do some social benefits repayment. If you have EI but your net income is over that threshold, and you have and or you have old age security income over the second threshold. Now, it is uncommon, but entirely possible for someone to be receiving both EI and old age security. Remember that there is no age limit for EI, so someone could be working past age 70 and then thrown into unemployment through no fault of their own and collect EI. It's entirely possible, although uncommon. So the calculation works like this. So we add in the old age security and the supplements first, deduct any overpayment, and then this gives the net amount of old age security for this calculation, line 5 here. Then we take the net income from line 23400, and then we calculate how much of the EI needs to be repaid, right? So the EI, what this means is the EI that's repaid is then going to be deducted from the net income, which is going to be used to calculate the old age security repayment. In other words, the EI repayment happens first. Now, the RDSP, what that means by net of RDSP is if you've received any income from an RDSP, that is a registered disability savings plan, it is not subject to this calculation. So RDSP income is added in here. So net of means what's left after you subtract the RDSP income. Also, any universal child care benefit income is added in here. And so that is also not subject to this calculation. Now, UCCB income is very uncommon now. Theoretically, there could be some people that applied for it late, but off the top of my head, the UCCB stopped being paid out in 2015. So I think even historically, we're very unlikely to see any UCCB benefits showing up. And if they haven't entirely gone away, they will be within a few years, I'm sure. But for now, they are still on the form. But the RDSP income is not going anywhere, so that could happen. And it's entirely possible for a senior citizen to be receiving RDSP income. All right, so that's what that means. So you take your net income, and then you subtract the EI, any EI that you've repaid, any UCCB, and any RDSP income, and then that income which is left is your adjusted net income. Then we deduct the $90,997 from that, and then that result, the amount over $90,997, is multiplied by 15%, and then we look at that. If that is less than the old age security benefits, then that's what you repay. If it's more than that, then you just have to repay the old age security benefits. Okay. And what that means is that amount that you are repaying is then entered as a deduction on line 23500. So that portion of your old age security benefits is no longer considered income. You're not going to be taxed on it. It is deducted there because it is going to be added as something you need to pay back on line 42200 of the return. So it's going to be added to your total payable. Okay, so there's a lot of moving parts there, and it looks complicated, but if you go through in order, it's not so bad. You basically, things to remember are you deduct any EI repayment first, and certain income types are also not considered. So RDSP income and UCCB income. And otherwise, it is the old age security above this threshold amount, and you either repay 15% of that income back, or all of your old age security income, whatever the total amount is. All right. And as it notes here, there's a repayment chart on the back of a T4E slip to allow you to do that calculation there without cluttering up the federal worksheet. Now, in a case where someone has to repay, as I was just mentioning, in a case where someone has to repay their old age security, then the government will assume, their default assumption will be, hey, this senior probably has an income which is likely to be high again next year, we should withhold some of their old age security at source so as they don't have to run into trouble and have to repay us at the end. So it's rather than us giving it to them and then handing it back to us, we will just keep it to begin with, and thus to save them the trouble. So the government will therefore withhold 1/12 of their estimated OAS repayment each month if a taxpayer had a repayment in the prior year. So if you had to repay $2,000, $2,400 one year, the government will withhold $2,400 the next year, and 1/12 of that would be $200 a month. So this is reported in box 22 of the T4A OAS slip as income tax withheld. Now, of course, it's a little more complicated than that. So the first 6 months of withholding is based on income in the second preceding year, and the second 6 months of withholding is based on income in the preceding year. So if you had a year of high income followed by a year of low income, or vice versa, then you might see some variation in what is withheld. The government is aware that seniors' income will sometimes fluctuate due to the unpredictability of investments and so on. So that's what this is meant to reflect. All right. Now, the mechanics of the calculations are illustrated in illustration 11-2. I want to press on those because we've got a fair bit to cover tonight. So I'm just going to press on a bit more until we get to our break. So do bear with me. Yeah, I know, a few more slides for the break. Not too much though. Okay, so that's old age security that we've talked about. Why taking 2 months of 2 different years? Remember that that income tax is due in April, right? So in general, adjustments to your various benefits only kick in July. So most things that are prorated in this way, therefore, use this methodology of the 6 months from 2 years ago and 6 months from the previous year. To offset this effect of the possibility of a high income one year and a low income the next year. And we're going to run into this again when we talk about installments. I think the short answer is that is a more workable way of doing it for them. Trying to prorate it each month would simply not be possible. The basic problem with the government is that for any kind of benefit or things like that, the only information they have for you is what's on your tax return. So if your income was high in one year and then drops through the floor in the following year, the government has no way of knowing that until you file your taxes next year. So sometimes certain benefits and things can lag as a result. That I think is the short version. All right, now CPP retirement benefits, as I mentioned, these usually are sent out together with old age security benefits, and they are reported on an orange or peach-colored CPP T4AP slip. Now, we've talked about those before, and remember that there are various kinds of benefits on a T4AP. The two that are generally paid to seniors are the survivor benefit in box 15 and post-retirement benefits in box 19. Now, sorry, I'm just making a note, putting a post-it in my notes. The total amount of the taxable CPP benefits is reported in box 20 and then entered on line 11400 of the tax return. And so the taxable benefits in box 20, we report those on line 11400, as we mentioned before. And the box 14 and 15, the retirement benefit and the survivor benefit, these are included in box 20, as well as the post-retirement benefit in box 19. Okay, all right. Okay, good. And sorry, I'm just circling something in my notes here. Now, for CPP, unlike OAS, you can apply for CPP early. between the ages of 60 to 65, and it is not necessary to stop working to apply for CPP benefits. This may be appropriate in a case where someone financially doesn't need to keep working and wants to reduce the stress on themselves, or perhaps someone is has a terminal illness and is not expecting to live so long and would like to collect their retirement benefits early. There's any number of reasons people might do this. So you can start collecting them at age 60. However, for an early application, the CPP will permanently be reduced because you're going to be receiving it for a longer period of time. It needs to be stretched out over a longer period of time. There's reasoning there. So for an early application, the CPP will be permanently reduced by 0.6% for every month the applicant is under age 65. Therefore, the maximum reduction is 36%. That is 60 months times 0.6%. In order to start collecting at age 60, you do have to apply for it. And if they continue to have employment income, they still need to continue to contribute to CPP. Now, once you hit age 65, you will still have CPP contributions deducted, but as we touched on before, at age 65, you have the option to file Form CPT 30 to stop contributing. Now, the flip side is late retirement. So, as with old age security, taxpayers have the option to hold off collecting it. You may elect to postpone CPP until the age of 70. So this can be advantageous if you're in good health, you're continuing to work, you anticipate living a long, long time. So for those taxpayers, CPP is then permanently increased by 0.7% for each month that the payments are postponed past the age of 65. And here the maximum increase is 42%. 60 months times 0.7% a month. Now, if you continue working after you retire, these are called post-retirement benefits. These are reported on T4AP in the box 19. So these contributions are mandatory for early retirees between 60 and 65 who continue to work, and these are optional for CPP recipients between 65 and 70 who continue to work. Of course, again, recipients over 65 can file CPT 30 to stop the contributions. All right, now if a taxpayer informs the CRA but doesn't tell the employer, any CPP contributions withheld in error are then refunded as a CPP overpayment. Now, just make sure there is actually a question. Illustration 11-2, you'd like to have a look at that? I think I'd like to take the break and then look at illustration 11-2, if you don't mind. I want to just touch on a couple things, two more slides, then we'll take our break because it is already 7:34, and I think some of you may need a break. So we're going to do two more slides. We'll take our break, and then after the break, we'll look at illustration 11-2. Okay. All right. So now let me get back here. Now there's an important unusual feature of CPP benefits, which it's good to be aware of, and that's called CPP benefits sharing. So what is this? So spouses, common law partners, may be able to apply to Service Canada to have their CPP retirement benefits shared between them. Now, only the retirement benefits can be shared, not other kinds of CPP benefits. And to do this, both spouses or common law partners must be over 60. Now, the amount that is shared can be shared depends on how long the couple live together during their contributory periods. Now, this cannot be done as part of the tax return. You have to apply directly to Employment and Social Development Canada, and it only applies to the retirement benefits earned while the couple was living together. Pension benefits that were earned prior to that date cannot be shared. Now, this sharing of CPP is different than other types of income sharing that we're going to look at. This isn't income splitting in the usual sense. This actually changes the amount of the CPP payments the couple will receive, and it changes the amounts that are going to show up in their T4APs as a result. Now, so one example of a situation where you might do this would be if you had a couple who've been living together since they were in their 20s, and one spouse never worked, and so therefore normally would not be receiving any CPP. So if they applied for CPP sharing, both spouses will receive CPP payments and T4APs, and the combined CPP payments would then be equivalent to the CPP the taxpayer would have received. All right. And so there might be situations in which this would be advantageous. I can think of a few off the top of my head. So unlike other types of attribution, for example, if one spouse had a really high income, it might be beneficial to split the CPP in this way. This is different from other kinds of pension income splitting that we'll talk about later tonight. This is a special rule that only applies to CPP. All right, so before our break then, let's have one more poll question, just to help see how alert everyone is. This is poll question number 1. Pull this up and set the timer. Oh. All right, and here is our poll question. Let's get back in. All right, so the poll question is, so if you've been paying attention, shouldn't be too hard, which of the following pension incomes are taxable? CPP, OAS, or both? All right, you've got a minute. All right, there we go, and WebEx is just tabulating that result for a moment. All right, so the correct answer then is actually both. So what we are getting at here is, remember, old age security is taxable. The guaranteed income supplement, the GIS, is technically not old age security, but paid out with old age security, right? So GIS is not taxable. The GIS allowance is not taxable, but old age security itself is. So CPP and OAS are taxable. Remember, the GIS is reported on a separate line from the OAS payments. Okay, so on that note, it is now 7:40 basically, so let's take a 15-minute break. All right, and break until get back into things. All right, so welcome back, those of you who've downloaded this online. So we've had our 15 minutes break here, and we're going to continue. Now, I had a request to look at illustration 11-2 in the textbook, so we're going to go do that now. Now, so this is about OAS repayment, and I think the slide describing it might have been a little hard to visualize, so let's look at this illustration, an example of a repayment calculation. So in this case, Herm Sanders is our taxpayer, and Herm received $9,408.49 in OAS benefits. Net income for the year was $95,000, which is just over the threshold, and he didn't receive any EI benefits to reduce that number. So therefore, his OAS repayment is going to be calculated as the lesser of $9,408.49, that is having to repay all of the OAS benefits, or 15% of the income over 95,000. So 15% of 95,000 minus 90,997 is $600.45. So that's what he has to repay. So again, this amount that he has to repay, in tax terms, it's treated as if he never received it. So it is entered on line 42200 and added to his total payable, but because he has to pay it back, he is then deducting it at line 23500. So it's not subject to tax. Effectively, it is as if he never received it, which is the idea there. Now, that will lead to monthly withholding of recovery tax. So if you had to repay in a year, the next year you're going to have to have some of your old age security withheld. So again, as we mentioned before the break, the estimate for the first 6 months of the year is going to be based on the taxpayer's income from 2 years ago, and for the last 6 months, it's going to be based on their income for the previous year. So if you didn't have to repay 1 year and then had to repay the next year, the first 6 months, you wouldn't have a withholding going on. And then at the end of the year, when the return is filed, the actual repayment amount is calculated. If they paid too much, it's just like any other tax refund. And if they paid too little, it is deducted from their refund or added to the taxes owing. So illustration 11-2 takes Herm Sanders and spins them into a full example. All right, so he had a net income of 91,000 in 2022 and 93,000 in 2023. And since the government uses his prior year's income to estimate the withholding, he's subject to withholding as follows. All right, so so notice his income in 2022 is just over the threshold. It's only over the threshold by $3, right? So we divide that $3 by 12, right? And that's the amount per month, right? Not by 6. We want to get a monthly amount, and then we use it for 6 months. So that, so he pays 25 cents a month because there's 12 months in a year. We want to get a monthly amount. That's right, 12 months in a year. If we divided it by 6, that would be appropriate to get a bi-monthly amount. So, so just to be clear here, right? So we take, is there a way to make that smaller? No, not really. Okay, so 91,000 minus 90,997, 3, right? He was over the threshold. 2 years ago, he was over the threshold by $3. So that would be what he would have to repay for the year. However, we're going to spread this out into a monthly amount. So we divide that by 12, and that's 25 cents per month. And if we were only basing it on the 1 year, he would pay 25 cents every month to add up to the $3. But instead, we're only basing the first 6 months on this income from 2 years ago. So it's 25 cents a month for the first 6 months. And then for the second 6 months, right? So for the second 6 months, we compare the 93,000 to this amount. So we take the 93,000, subtract the 90,997, right? And that gives us 2,003. We divide that by 12. Is that right? That doesn't seem. And that gives us that amount. Oh, right. Times 15%. Yeah. Right. Okay. I got it. So that's the idea. 15% of 3. Yeah. All right. 3 times 15%. Yes. 15% of the amount over, and then divided by 12. Yes. Yeah, so 15% of $3, then divided by 12. Yes, I see what you're saying, students. Yes, okay. All right, so in the first case then, yes, good catch, students. Right, so again, you have to repay 15% of the amount over the threshold, so 91,000 minus 90,997. Right, so that's $3 over the threshold. We multiply that by 15%. So they'd have to repay 45 cents, and that would be divided by 12. Right, so the 25 cents here is small. The 2504 is more accurate, I think. So 93,000 minus 90,997. All right, so divided by, times 15% would be the overpayment. And that divided by 12, yes, that gives us the 2504. Okay, so they in the first line, they forgot to do the 15%. That makes sense. All right, good catch. All right. Okay, so I will make a note of that. I will pass that along, and we will get that fixed. Okay. Right, good catch. Right, so the second line is the correct one here. The general principle, however, is the key thing to take away, and that is that the government estimates how much you have to repay based on the amount that's over. And the estimate is on an average, essentially, of the previous 2 years. All right. Okay, so this amount being withheld here, then is reported in box 22, as shown in the T4A OAS. Okay, yes, I apologize for any confusion there, students. I will pass that along. We will get that fixed, because that is inconsistent one to the other. Okay, but good catch. And now, there are some cases, by the way, in tax where a sort of simplified thing is used. So, like if, say, the government said it has to be a minimum amount of 25 cents or something like that, but I'm not aware of any such rule, right? Yeah, so it should be 4 cents a month. Times 6 would be 25 cents total, but I don't think that's what we're going for here. All right, thank you. All right, thank you, students. Okay, so yes, that was a good catch. All right, so now we're going to talk about pension income. Now, when we talk about pension income for tax purposes, it's important to note we always mean, by pension income, we mean pension income other than CPP or OAS income. Pension income can be broadly defined as an annuity that is received generally for someone who 65 or older. However, depending on the situation, it may be reported on a different line in the tax return. So if it is reported by someone 65 or over, then it is generally going to be treated as pension income. But if someone is not under 65, then it may wind up on one of these other lines. It may show up on line 12900, 13000, or in rare cases, 12100. Now, we're going to look at various kinds of pension income to show you where the slides are going to be. Now, if you have your facts and figures guide open in eDoc, this I think could be helpful. Because in the facts and figures, we have a reporting guide. Right? And retirement income. Where is it? Where is it? Federal. I want federal, not Quebec. There we are. So it's figure 34, the reporting guide for retirement income. Now, let's take a moment and have a look at this chart. Now, in this chart, what is all this about? So, when someone, figure 34. Thanks, Diane. I need to add that to the notes for next time, so I can get it more quickly. So as you can see, there's various sorts of pension-like income that someone can receive. And depending on whether someone is 65 or older or not, this will affect how it is treated for tax purposes. So, and this is important because there is a tax credit called the pension income amount, which, as we will see, effectively means that your first $2,000 of pension income is not taxable. It receives a tax credit. And this is what's meant over here on the right-hand side for the pension income amount. Over here. So to give a simple example, if you have income in a box 22 on a T3, this is a lump sum payment from a pension plan, and this is entered on line 13000, other income, and it is not eligible for the pension income amount. But if you do have pension income that is paid out periodically, it will be on box 31 of a T3, and this is entered on line 11500, and this is eligible for the pension income amount. Now, groups 2 and 3 are the other two groups of people who can receive pensions. For group 2, these are people who are under 65 but receiving these benefits due to the death of a spouse or common law partner. Group 3 is for persons under 65 who are receiving these benefits, but not due to the death of a spouse or common law partner. So for each of these individual types of income, you need to know what is the situation, who is receiving them, and why they are receiving the pension. So pensions in general, their tax treatment is fairly straightforward. The main complicating thing is you need to be able to identify what type of pension it is and how to report it and whether it qualifies for the special tax treatment for pension income. Now, what you guys can do is have this chart open in another window if you can, and then we're going to go through these various different types. So I'm going to go through some slides, talk about various types of pension income, and if you've got this chart with you, you can have a look at it and say, yes, this makes sense. Okay, but main thing is that you're aware of this chart. So now, what makes something pension income, by the way, in general, is that it is an annuity. That is, it is paid on a fixed schedule in regular payments. So a regular amount is received according to a fixed schedule, and it is not variable. And the purpose of a pension, as opposed to annuities in general, is that it should be for someone 65 or older who is often sometimes referred to as a pensioner, right? That is why it receives the special treatment, is the basic thrust of it. So let's look at some types of pensions, and I think you'll see where the variation comes in. So income from a retirement pension plan, an RPP that we've been talking about. If the payments are periodic, that is regular annuity payments, they will appear in box 16 of a T4A. If it's a lump sum payment, you're making a large withdrawal or the plan cashes out or something like that, you get kind of a irregular bonus payment of some type, then this is reported in box 108 of a T4A, and this is included in box 18 of the T4A. A deferred profit sharing plan. So these are profit sharing payments from a company that have been delayed. So if this amount appears in box 24 of a T4A, then it is treated as annuity or installment payments. But if it's in box 180, that's for lump sum payments, which are included in box 18. So you can see the general division. Regular payments according to a schedule and a fixed amount, annuity or installment payments, periodic payments, those are classic pension income. Kind of lump sum, irregular payments tend to not be treated as pension income and instead treated as another type of income, usually other income on line 13000. Now, foreign pensions are interesting because foreign pensions always report the full amount of the pension on line 11500 in Canadian dollars. And it's important to note that because sometimes some pensions, in particular U.S. Social Security, have a tax-exempt portion according to the Income Tax Act, or Canada has a tax treaty to that particular country. In the case where some of a foreign pension is exempt, you report the entire amount on line 11500, and any tax-exempt portion is claimed as a deduction on line 25600. Now, many Canadian residents receive foreign pensions, and if we look at the rules for foreign pensions in the chart, foreign pensions, they're down here, for example. All groups treat them as pension income on line 11500, and there's generally no Canadian, there's never going to be a Canadian slip for him. That's what no slip means here. Now, to give you an example of how this would work in practice, say, my wife, inherited a pension from her mother, and her mother was an employee of the state of Missouri, and so received a Missouri state employees government pension. So my wife received this foreign pension, but because foreign pensions are always treated as pension income in the hands of the recipient, regardless of which group they fall in, this was treated as pension income on line 115. So every year, this amount in U.S. dollars would be converted to we'd have to convert it to Canadian dollars and report it on line 11500. So, registered retirement income funds. Now, this a T4 RIF. Oh, hang on, sorry. I think I need to mention about U.S. Social Security. U.S. Social Security benefits have a special exemption, which in fact is built into most tax software. In most cases, they are exempt from tax at a 15% rate. So 15% of the Social Security benefits of the U.S. Social Security benefits are tax exempt, and so they are deducted on line 25600. Now, historically, there are a handful of special cases where Social Security is exempt at a higher rate, 50%, but that is extremely rare now. The taxpayer would have had to be a resident of Canada since 1995 and receiving Social Security benefits continuously since then. Since that's 30 years ago now, the number of Canadian residents receiving U.S. Social Security benefits and have been receiving them since 1995 is going to be pretty dwindling. But just be aware, if you see a reference to a higher exemption rate, that's what that's about. Now, again, the key thing we want to stress to you is always report the full amount of the pension on line 11500 and then the exempt amount later. In the facts and figures, there's also a section on the tax effects of tax treaties on foreign pensions. We don't have enough time to go into it here and now, but have a look at it and you can see that various countries have different exemption rates in effect. What can sometimes be tricky is determining whether a given foreign pension is a Social Security pension or not. So this involves asking the client questions, and if information needs to be sent to the CRA, sometimes involves the client needing to pay for a translation of the given document, and so on. Sorry, Mohammed, is it possible? What is possible? Oh, for the U.S. Social Security exemption? It would theoretically be possible. So assuming they've been receiving U.S. Social Security started at age 65, 30 years ago, I mean, they would be very close to 100 now, but it is possible. It is possible. Remember, though, that when we do tax, we can do tax for tax returns up to 10 years old. At this point, so it is possible you might be going back and doing tax for someone retroactively. But yeah, it's still theoretically possible. It'll be a few years yet before I think we see the very last of that. But what's more likely is that someone will have heard something and they come in and say, hey, I thought U.S. Social Security was exempt at 50%. Right? Because that often happens. Someone comes in to see us or get their taxes done, and they have the old information. So we'd like to mention it on that basis, in case someone asks about it. People do sometimes come in and they ask about something which hasn't been applicable for 10 years. So if you're aware of that, then you are better able to, have that conversation. That's most of the reason we're mentioning it. All right. Now, again, we don't want to spend a lot of time on that. Main thing is we just want you to know that tax treaties exist, and you can find this information in the facts and figures. All right, now, Registered Retirement Income Funds, T4RIFs. T4RIFs, so this is what an RSP is converted into. Registered Retirement Savings Plan, once the taxpayer turns 71, is intended to be converted into an annuity, and then it becomes a Registered Retirement Income Fund. Now, sometimes this doesn't happen right away, and you'll instead be receiving annuity payments on a T4 RSP. But if it is from a retirement income fund, then it will appear in a T4 RIF. Box 16 here will have the taxable amount. So that is the regular payment, ordinary amounts, the periodic amount. Now, if you had to take out extra payments, or extra payments were made for some reason, so you had to withdraw from it for an emergency, any excess amount appears in box 24. Now, the excess amount is included in the taxable amount, but the excess amount is what is the excess amount is what income tax is withheld at source based on. So that tax that is deducted in box 28 is only calculated on the excess amount. Now, if a spouse common law partner was a contributor, then there will be an indicator over here, box 26, and then box 32 will have the social insurance number. Now, other things here. That print is a little small. Box 22 is for other income or deductions. So if it is positive, it is other income, which will appear on line 13000. If it's a negative number, the plan lost money, then there will be a deduction on line 23200. If someone dies, the RRSP can sometimes pass into the hands of someone who cannot transfer it into their RRSP, in which case you would have amounts that are deemed received and therefore become taxable immediately. So either due to death or deregistration, like the plans can sometimes be deregistered, usually due to administrative reasons at the financial institution involved, I would think. All right, and for registered RIFs, and again, if you don't have the chat to see in the charts there, a registered RIF, so they are handled here. So you can see amounts in box 16 is an annuity, and depending on the group you're in, it will be treated as pension income or other income. But deemed receipt in box 18 is other income. Deregistration, which depends on the situation. Group 1 treats it as pension income. Groups 2 and 3 treated as other income. Right. So again, for any of these various pensions we're touching on, the information part will be helpful. Now, for general annuities, unregistered annuities, so these are annuities which are paid out which are not from a registered plan. They haven't enjoyed any specialized tax savings. So with this, it's important to understand that some of the money in an annuity plan is money that the taxpayers put into the plan. That money is post-tax income. The only taxable portion on an unregistered that appears. So all that's going to appear on the box 24, the T4A, or box 19 of a T5, is the earnings of the plan. Now, if an unregistered annuity is reported on a T5 in box 19, it's not treated as pension income if it's received by someone in group 3, and it is instead treated as investment income. So this is one of the few times when annuity type income appears on line 12100. Income averaging annuity contracts will either appear on box 111 of a T4A, and then it's included in box 24, or again, T5 in box 19. And again, if someone in group 3 is receiving it, it will be treated as investment income. Now, there's an unusual form called a retirement compensation arrangement, and this is called a T4 RCA. The plan itself is called a retirement compensation arrangement, or RCA, and then the income is reported in a T4A RCA slip. Typically, income from RCAs is treated as other income, and no pension income can be claimed. However, box 17 of an RCA, while it's included in box 16, distributions from the plan, is eligible for pension income splitting. So it is partially treated like pension income. It's not eligible for the pension income amount, but it's eligible for pension income splitting, which we'll talk about shortly. Now, there may be, at this level, don't worry too much about RCAs. There may be various special cases, but those special scenarios will require additional documentation. There are more details in the textbook if you are interested, but we don't need to get into it too much. RCAs are relatively rare. These are, in general, I think I would say, you can think of them as special arrangements for very high income earners such as executives and in similar situations to that, rather than standard pension plans. Now, when you turn 71, your RSP is supposed to be transferred into an RRIF. However, if that doesn't happen right away, it is possible you may be receiving income on a T4 RSP for RSP income or PRPP income. So that type of income is reported on a T4 RSP. And again, if the spouse was a contributor, and there will be a yes in box 24, and the social insurance number shows up in box 36. Remember, special care will need to be taken there if there were any contributions in the last 3 years. Because remember, if the spouse withdraws from the plan within 3 years of the contributor putting in money, then it may be attributed back to the contributor. Otherwise, annuity payments, box 16, are generally treated as pension income, and unusual payments, one-time payments will be in box 22. So if you're just pulling money out of the plan, not according to an annuity, it'll show up here. And again, home buyers plan, LLP withdrawals show up here as well. And other income can show up here as well. Box 16, the annuity payments, that's the pension type income. Now, retiring allowances are an interesting phenomenon. So what this is a payout when someone leaves the company. Typically, they are cashing out from the company pension plan. So you're no longer working for the company, we're no longer to keep you in the company pension plan, so we're going to give you an amount of money as compensation, is the basic idea. So these allowances are reported on a T4 in box 66 and or box 67. They are not employment income per se. They are therefore not included in box 14. And this is important. If you need to be aware of this. It's not included in box 14, so they have to be entered. Not entering them on the tax return will result in trouble. So box 66 and box 67 combined are instead reported on line 13000. Now, box 66 is eligible for a transfer, and box 67 is not eligible for a transfer. What is a transfer, you say? Well, remember when we looked at Schedule 7? A portion of this amount that is eligible for a transfer can be directly transferred into an existing RPP, can be instantly, or, well, not quite instantly, but basically can be transferred into an RPP, RRSP, or PRPP, either directly through the financial institution and source, or indirectly. It passes through the taxpayer's hands. The taxpayer takes the money out of one financial institution, walks across the street, puts it into another financial institution. The key point is that a transfer does not affect the RRSP or PRPP contribution limit. You can always do a transfer. Essentially, this money, one way or another, has already been applied against the contribution limit in a past year, so you are allowed to just move it from one plan to another plan, essentially. However, in order to claim something as a transfer, you need a contribution receipt. A mistake that beginning tax professionals sometimes make is they see an amount in box 66 and say, oh, this must have gone into an RSP, and just claim it as an RSP contribution when in fact it did not, and there is no documentation of that. Again, just to be clear, the amount that is transferred per the RSP receipt in the year has to be included on Schedule 7 on line 24640 to ensure the RSP deduction limit is not affected. So, for example, Bill retired in the middle of July 2024 and received an eligible retiring allowance of $17,000. These funds were transferred into an RSP in July 2024. Bill received a corresponding $17,000 RSP contribution receipt for this amount, and his RSP deduction is $54,325. So, does this show up in income, and if so, where? So this appears on line 13000. So it shows up in the income. Now then, does he get it? One at a time. Does he get a deduction for the $17,000 RSP contribution receipt he has? And where does that show up? Where do we claim that? Good, line 20800, right? So that's the key point. If you're transferring the money, you're pulling, effectively it's coming out of one retirement plan and you put it back into another retirement plan, so you don't have to, you're not keeping it out, in other words, then you get a deduction to offset it. You don't have to pay any additional income tax on it. And that can be very important because typically a retiring allowance might be very large. You might be getting tens of thousands of dollars. And so if you included that in income all at the same time, you might have to pay quite a bit. Yeah. And does anything change if his RRSP deduction limit is less than $17,000? Good, students, you're correct. No, nothing changes. Again, the transfers are not dependent on the deduction limit. This is the key point, right? Even if the deduction limit is 0, if it is a transfer in box 66 identified as such, you could still move them into another RSP. Box 67 is the amount that is not eligible for transfer. Box 67 can only be moved into an RSP if you have contribution rate, and it is not a transfer. It's a regular contribution. Box 66 can bypass the contribution limit restriction. Okay, so direct versus indirect transfers. With a direct transfer, it's paid directly into the plan. It doesn't pass through the taxpayer's hands, and in this case, no income tax is deducted. With an indirect transfer, the income is paid to the taxpayer, who then transfers it into a registered plan, so it passes through the taxpayer's hands. And this means they may keep some of it. They may not necessarily put as much back into a plan as they pulled out. In this case, income tax is deducted at source. But to qualify as a transfer, as opposed to just a regular RSP contribution, the contribution has to be made in the same taxation year the income was received, or in the first 60 days of the next year. And the deduction has to be claimed in the same year the income was reported. Now, you can probably notice that there's a potential problem which can arise here. Taxpayers need to be very careful when a retirement allowance is received in the first 2 months of the year and then transferred to an RSP. Because remember, the first 2 months of the year, so the income is then received in the taxation year. So for example, if you receive a retirement allowance in the first 2 months of 2025, you receive it in taxation year 2025. But in order to claim the transfer, it has to go into the RSP after the first 60 days of 2025, because otherwise it has to go into 2024. You cannot have a transfer show up in the taxation year before you received it, if you follow me. So that's what this restriction means. The deduction has to be claimed in the same year the income was reported. So you need to keep an eye on that. And other points here. Transfers, although mostly these are made to RSPs, they can be made to other types of plans, RPPs, PRPPs, DPSPs, and RRIFs. FHSAs are only eligible for direct transfers. And there are rules for most of the common types of transfers. There's more information in the textbook. You don't need to memorize them all, but just, again, know where to find the information if you need it. If there's get back here. There we go. Now, indirect transfers can be complicated if it's because of the death of an RSP annuitant. So in this case, payments due to the death of an annuitant are reported in box 34. In this case, you can file a form to have some of this income retreated as a refund of premiums in the hands of the surviving spouse or common law partner, and thus be exempt from tax. And if they can also be transferred into the a dependent child or grandchild, or an RDSP. But if the child is not infirm, a transferred annuity cannot be extended beyond the 18th birthday. So again, there are some key rules which happen here. There's a similar rule which applies to receiving these due to the death of an RRIF annuitant. These are reported box 18 of the T4RIF. And again, an election can be made with form T1090. Again, they can be transferred into an RDSP. And if the child is not infirm, the annuity cannot extend beyond the 18th birthday. Okay, otherwise, rules for receiving something on the death of an RSP annuitant. Essentially, by having them treated as an annuity, they still qualify for the special treatment around pensions. All right. Now clicked the wrong thing there. The lump sum pension income. Generally, lump sum pension income can only be transferred directly. So if indirect transfers can't come up here. There's a few exceptions. So if it's a lump sum from a non-registered plan, you entered into while it was not a resident of Canada, amounts in box 22 of a T3 slip, and certain lump sum DPSP payments and lump sum payments from US IRAs. Again, these are listed in the textbook in more detail if you want to go into it. Right. So we're not trying to overwhelm you with the detail. We just want to give you some idea of the variety that's out there. Okay. So poll question here. And there we go. So let's see how well you remember this one. So true or false, if a taxpayer has foreign pension income, they must report the net amount in Canadian dollars on line 11500. And again, 11500, the pension income line. Very good, students. All right. Now, this question I think might seem a little ambiguous. Remember that some foreign pensions are partially exempt from Canadian tax, and so therefore only the net amount would be taxable. However, the total amount of the pension has to be reported on line 11500. So this in this case is false. You report the total amount, not the net amount, and then the exempt portion is deducted on line 25600. Remember, not all foreign pensions are partially exempt as well. So you need to look up the, it's not 12100. 12100 is reserved for investment income or certain unregistered annuities, as we've discussed. Foreign pensions are always treated as pension income, and when they are partially exempt, the exempt portion is deducted on line 25600. Okay, we had a full 15-minute break, so we're not going to take another short one. And we are getting close to 9, so we will get as much covered as we can. I suspect we won't get to the chapter review problem, and you guys will have the weekend to work on it, which is perfectly fine. I would rather take a little more time and go through this in detail rather than try to rush some of the things. That said, a lot of what we're going to be covering is fairly straightforward. So we're going to talk about 2 credits, and we've seen these credits before on Schedule 2. These can be transferred between spouses. So first is the age amount, and this is aimed at taxpayers 65 or older of modest income. So for 2024, you will receive a credit of $8,790 if your net income is $44,325 or less. It will then be reduced by 15% of the net income in excess of that amount, by 15% of the net income in excess. So that means the credit is reduced to 0 when the net income is over $102,925. I think we can agree that a senior with net income of $102,000 or more, is not really a low-income senior, at least for 2024. Similarly, there is also a pension income amount, and this is simply a non-refundable credit equal to the lesser of $2,000 and the total qualifying pension income. So this is an important component of that chart that we looked at. Does it qualify as a pension? Meaning, does it qualify for the pension income amount? This is exactly analogous to the Canada employment amount. It simply cancels out the tax on your first $2,000 of qualifying pension income. Key thing to remember is that this only covers non-CPP, non-OAS pensions, right? So this is pension from company pension plans or government union pension plans, not Social Security type pensions like the CPP or OAS. The pension income amount is claimed on line 31400. There may be a matching provincial credit, but it may not be $2,000, depending on the province. So, again, certain things are never eligible for the pension income amount. To review, CPP is never, OAS is never eligible for it. Lump sum payments are never eligible for it, and this makes sense if we think about it. The pension income amount is intended for annuity type income paid to a pensioner. So to qualify for the pension amount, then the senior, the pension has to be from a non-Canadian government source, so no CPP or OAS, that's how you can think of it. It must be periodic in nature, so an annuity and not a lump sum, right? And it must be subject to tax in Canada to begin with. So the exempt portion of foreign pensions does not qualify for the pension income amount because it is not subject to tax, right? So if you remember that, then it's fairly simple to remember the restrictions on the pension income amount. So it needs to be a non-government pension, must be periodic in nature, and must be subject to tax in Canada. All right. Get back here. Now, the other implication of something being designated as pension income is a fairly important concept called pension income splitting. And I think this is going to take the bulk of our remaining time, and that's okay because this can be a little tricky sometimes to follow. So I'm going to try to take my time and make sure it's really clear. So when you have spouses and one of them has pension income, often in a retirement situation, one spouse, for example, maybe worked more during their working life, and so they have a very large pension, and the other spouse may have much less pension income. So because the primary spouse doing most of the work has a larger pension, right? In a classic scenario. So in order to reduce the burden on these seniors when they retire, they have the option to have up to 50% of eligible pension income for tax purposes reported on the spouse or common law partner's return. Now, this allows them to reduce the overall tax burden on the couple by moving some of the income from the higher income spouse to the lower income spouse for tax purposes. Right? So this is kind of not an investment, so it's not question. It's not that this is an exception to the attribution rules, but this is kind of counter to what we saw with attribution. So in this case, it's to reduce the tax burden is the overall thrust of it. It's important to understand that this is optional. Couples do not have to do this, and if they do it 1 year, they're not required to do it again the next year. And both spouses have to sign off of it. So the form has to be done in quadruplicate, in other words. The election form is completed and signed by both spouses, and then a copy is included on each of their tax returns. So they each retain a copy, and a copy of each is sent to the government of this form T1032. Now, for this, there's your higher income spouse and your lower income spouse, classically. So the person with the higher income is transferring some of their pension income to the lower income spouse. So to qualify, the transferring spouse or common law partner in the Income Tax Act, they refer to as the pensioner, simply meaning the person who receives the pension. So in order to qualify for this treatment, they have to be resident of Canada at the end of the year or before they die, for a partial year return. When they die during the year, they can still take advantage of this. They must be the recipient of income that is eligible for the pension income amount, and they must be married or living in a common law partner relationship. Notice there is no age requirement. So when my wife was receiving had inherited her mother's Missouri government employees pension, we were eligible for pension income splitting. So she was able to report some on her return and transfer some of it to me. So we were each, for those years, receiving a foreign pension income in a small amount. I actually had a call from the CRA asking me, hey, what is this? And I said, oh, that's a Missouri government pension. And they said, okay, great, carry on. They didn't require documentation or anything like that. So just to point out that this will pop up in some context where you might not necessarily expect it. All right, so the transferring spouse, the only conditions then are resident of Canada, receiving pension income, and married or in a common law partner relationship. The receiving spouse or common law partner or in the Income Tax Act, referred to as the pension transferee, the person receiving the transferred pension income. they have to be a resident in Canada at the end of the year or before their death. They need to have been a spouse or common law partner of the pensioner at any time in the taxation year, and the relationship cannot have broken down in the year. So they cannot be in the process of a separation. They cannot be living apart at the end of the taxation year for a period of 90 days or more commencing in the taxation year due to the breakdown of the relationship. So in other words, if they start living apart in December and then 2 months later become formally separated, even though their marital status for the taxation year would show as married, they were in fact in the process of a separation. So that's the thrust behind this rule. All right. And again, this is only for taxation purposes. No actual physical transfer of funds takes place. So the election to split the pension income is made on Form T1032, and you can split up to 50% of the eligible pension income. You can opt to split less. You will typically split the amount which is most advantageous. Most decent tax software will allow you to run various calculations to figure out what is the optimal amount. This can be affected by a variety of factors. Now, if you're only living together for part of the year, the maximum split pension amount is going to be prorated based on the number of months. The elected amount at source is also claimed proportionately. So if you've had pension income and you've had income tax withheld on it, if you transfer some of that pension income to the partner, the income tax that was withheld will also transfer to the partner. So it's not the case that one person will get all of the income tax withheld as a credit and the other person won't get any. Otherwise, you would have some, it's more of a matter of convenience. So, now, pension income splitting is fairly complex to administer. It's got a lot of downstream effects from it. So as a result, in order to ease the administrative burden on the CRA, adjustment requests for pension income splitting are not allowed for the full 10 years. You can only go back up to 3 previous tax years. And again, because when this happens, it changes the taxable income results for both spouses or common law partners, and it has a lot of downstream effects as a result. And so just so as to minimize that from getting completely out of hand, it can only be done for 3 previous tax years. If you could go back a full 10 years, you could see all kinds of cascading effects, and it would just be a nightmare to administer. So I think it's pretty clear why that this restriction is in place, just to keep it manageable. In general, with elections, it's important to remember that because they are optional, often in taxes, they're not always allowed to be done retroactively for optional things like that. So it is good that you're allowed to go back and adjust for up to 3 years, but you can see why they capped it at 3. Now, an important implication of this, and why my spouse and I split her pension income, is that each spouse is eligible for the pension income amount. So they are eligible for the $2,000 pension income amount if the receiving spouse or partner is 65 or older, or under 65, and it is an annuity. The transferred income is an annuity under a superannuation or pension plan, or they're under 65, but the income was eligible pension income in the hands of the pensioner because they were receiving it due to the death of a spouse or common law partner. So my spouse and I qualified under bullet point 2. The income was an annuity under a pension plan. Now, because of this, it's usually going to be advantageous to transfer at least $2,000 in pension income so that both spouses will get the pension income amount at 15%. If the spouse with the pension income actually had a significantly lower income than the higher income spouse. But in most cases, you would want to, if nothing else, transfer at least some pension to up to $2,000 to take advantage of this. Now, we just saw that the receiving spouse will be entered eligible for the pension amount even if they did not have their own pension income due to the election to split the income. Can you think of any other benefits or possible drawbacks of pension income split? So a possible drawback would be if it pushed the lower income spouse into a higher tax bracket. A possible benefit would be if this pulled the higher income spouse down into a lower tax bracket. This could also be beneficial if the higher income spouse had to repay OAS, as we saw, if their income was over the 90,000 some odd threshold. This pension income splitting could pull them down below that threshold. And remember, the age amount can be reduced by your income over a certain threshold. So pulling the higher income pensioners' income down may also benefit that. So if on the other hand, if the receiving spouse has a higher net income, the tax bill may increase. Right? They may be in a higher bracket as well. And their old age security repayment might increase, and their age amount might be reduced. So that's a thing to keep in mind. Now, Diane, an interesting thought about refundable tax credits. You're thinking something like the GST benefits, right? The thing to keep in mind is most of those are based on family net income, and a pension income split usually doesn't reduce the family income. It simply increases the amount of tax credits they can claim. The total income for the family will stay constant. None of the income is gotten rid of. It's just that it is, by spreading it out, you can qualify for more tax credits. Right? So I think that's the way to think about it. It's also important to note that an increase of net income to one spouse may have a negative effect on other government programs outside of the tax return. So if they're receiving some kind of benefits for, in particular, government subsidized housing, I think is one in BC which comes up, that's a possible drawback to net income. All right, good stuff, everybody. So we've only got like three more slides before the chapter review problem. I'm just going to tack those onto our next lesson, I think, because it's already 9 o'clock. What I would like, yeah, I know it's been a lot of hard sledding, and I would encourage you all to have a look at the textbook. Yeah, we're just going to talk briefly about installment payments and do a poll question, so it's not very complicated, and then get straight to the chapter review problem. So for homework over the weekend, after assuming you survive Halloween, right? So I want you to be very careful not to have, don't get eaten by werewolves or seduced by vampires or anything like that. Survive Halloween. Don't go into a sugar coma. So over the weekend, then finish off chapter review problem 11-1 if you haven't already. And right at the beginning of next class, we'll wrap up those last few slides, go through chapter review problem 11-1. where you are going to do a pension income splitting scenario. And then we'll go over the topics, just review everything at the beginning of next class, just make sure we're comfortable with everything. But otherwise, for next time, and again, you've got the weekend. So read the textbook, chapter 12, and try chapter review problems 12-1 and 12-2. So chapter 12 is about family situations. So these are things like dealing with things like change of marital status in the year, shared custody situations, childcare, things a little bit more complicated than we've talked about already as relating to dependents. Okay, so chapter 12 in the textbook, chapter review problems 11-1 if you haven't done it already, 12-1, 12-2, and we will get back to those on Monday. All right, so for everyone who's been everyone who downloaded this online, I wish you all a good weekend. We'll be back after Halloween, and we will finish off chapter 11 and then move into chapter 12. All right, have a good night, those of you online. We'll see you next time.